Trying to qualify for a USDA loan but worried your income is too high? What if I told you that USDA doesn't just look at your gross income, they actually allow you to subtract certain expenses before checking if you're eligible? That means you might be closer to qualifying than you think. Today I'm breaking down the 5 most common USDA income deductions, how each one of them works, and how they can help you or your client meet USDA's income limits. Now let's get into it. First things first, USDA loans come with income limits, and these limits vary based on the location of the property, the size of the household, and the total income of everyone living there. But here's the important part. USDA looks at your income after certain deductions. So even if your gross income is slightly over the limit, you could still qualify once these deductions are applied. So let's walk through the 5 most common deductions that USDA allows and how they work. The first and most common deduction is for minor children. So for every child under 18, USDA allows you to subtract $480 from your gross income. That means with one child, it's a $480 deduction. 2 children, $960. 3 children, $1,440, and so on and so on. So this deduction also applies to any full-time students under 18, even if they're working a part-time job. So if your household includes kids, that's an easy way to bring your qualifying income down and stay within USDA limits. If someone in the household is disabled, USDA may allow you to deduct certain out-of-pocket disability-related expenses. So examples include wheelchairs or walkers, accessibility ramps, home or vehicle modifications, workplace support equipment. Here's the rule. USDA allows you to deduct the portion of expense that exceeds 3% of your gross annual income. For example, if your gross income is $60,000, 3% of that is $1,800. If your disability expenses are $4,000, you can deduct $2,200, so $4,000 minus the $1,800. So this can make a big difference, especially for families with ongoing accessibility needs. Next up, if the applicant or co-applicant is 62 or older, USDA allows a flat deduction of $400. This is a one-time automatic deduction, no extra paperwork needed beyond verifying age. It applies even if that person is still working or retired. As long as one of the main applicants is 62 or older, you can qualify for this income reduction. This one often gets overlooked but can be huge if you qualify. If there's an elderly or disabled family member in the home and you're paying unreimbursed medical expenses, USDA lets you deduct those expenses. The rule is the same as with disability expenses. You can deduct any amount that exceeds 3% of the household gross annual income. So eligible expenses include prescription medications, doctor's visits, home health care, insurance premiums not through payroll deductions. So just make sure you keep a detailed list of documentation, so receipts, bills, records, because USDA will need proof that these are all real out-of-pocket expenses. This is one of the biggest deductions and one of the most misunderstood. USDA allows you to deduct the full cost of childcare for children 12 and under. There are no caps or percentage limits. You just need receipts or statements from a licensed provider, documentation showing you're actually paying for the care, and then proof that the child is actually under 13 years old. And here's why this matters. Let's say you pay $800 a month for childcare. That's $9,600 a year, fully deductible for your income when applying for a USDA loan. Even better, childcare is not considered a debt, so it does not impact your debt to income ratio. It only helps reduce your eligibility income, which helps you qualify. And if your income is already below the USDA limit, you don't even need to document childcare expenses at all. Still think your income is too high for a USDA loan? Let's take a second look. So these deductions can make a huge difference. $480 for each child, actual childcare expenses, medical and disability deductions over 3% of the gross income, a $400 deduction for seniors, and much more. Here's your action plan. Look up the USDA income limit for your area. You can actually find it on the USDA website. List every potential deduction your household may qualify for. Next, talk to a lender who understands USDA loans and can calculate your adjusted income the right way. Remember, USDA loans offer no down payment, lower interest rates, and flexible credit guidelines. So if your gross income is just a little too high, these deductions could help you get over the line. Want help reviewing your numbers or checking if you qualify? Click the link below, let's schedule a call, and let's walk through your USDA eligibility step by step. And if you found this video helpful, hit that subscribe button for more loan tips, income hacks, and buyer strategies.